A very warm welcome to you today for our Smart Investor webinar. My name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. Today I'm joined by Ashley Gardyne, our Chief Investment Officer, Sam Dickie, our Senior Portfolio Manager, one of them, and very warm welcome to one of our Senior Wealth Advisors in Christchurch, Nick Smith. So welcome, team. Today we're going to be taking you through a short presentation and then we're going to be opening up to some Q&A. So as many of you know, Fisher Funds provides managed funds and KiwiSaver for a range of clients, and we're really about helping clients achieve their investment goals. So today the team will be taking lots of questions. So you'll see down the very bottom there's a Q&A button. So please ask the questions and we'll do our very best to answer them. We do obviously have a great team of advisors, including people like Nick. So if we don't answer your question today and you do have any, then please pick up the phone, email us, and we'll be more than happy to help. So a couple of things before we get going. Just your attendance isn't visible to anybody else. The webinar today is general information only, so it doesn't take into account your own personal situation. But as I said, that's what we've got the great team at Fisher Funds for. And the webinar is being recorded. So I'm going to hand over to you, Sam, to start off and take us through a presentation. And I just wanted to acknowledge one of the industry's greats, Brian Gaynor from Milford, who passed away this week. And from all Fisher Funds, we send all our condolences to family and the team at Milford. So yeah, I'm going to pass on to you, Sam. Welcome.
Thank you very much, Cath. And yes, good afternoon, everyone. And I absolutely echo those thoughts. Brian Gaynor, a giant of the industry. May he rest in peace. So did anyone read the newspaper recently? What I mean by that is there is a lot of bad news out there at the moment, not least the articles you can see on the screen there. A real laundry list of bad news. So today I'm going to talk quickly through what is happening. What are we thinking about what's happening and what are we doing with our portfolios and what have we learned? So what is happening? There's a lot of bad news out there at the moment. Today, investors are worried about central banks withdrawing years of unprecedented stimulus, the highest inflation in a decade, sharply rising interest rates, spiking petrol prices, a tragic war, and now the risk of recession. It's quite a laundry list of bad news, but as active investors, we are more excited than we have been for quite some time about the opportunities in front of us today. So that is a chart of the bellwether global interest rate, price of money, the US 10-year bond yield. And the key concern this year has been high inflation and sharply rising interest rates. So we're not strangers to rising interest rates. They did rise quite a bit last year. That bond yield went up by about 50% or about half its yield last year. But this year, interest rates have really exploded. That's been the key change. And interest rates have more than doubled in 5 short months. And those are very, very sharp moves indeed, near unprecedented, the scale of those moves. The good news is a lot is priced in now. The bar is higher for further negative impacts from these rising interest rates. And if you're buying bonds now, the future return is a lot more attractive. So that's the first thing that happened. The second thing that happened is the pace of those interest rate moves is bad for share markets generally. It's bad for share markets generally as it reduces the value investors place on future cash flows. And while quality growth companies, which is our Fisher Funds' natural hunting ground, were hit, the lower quality, riskier end of the spectrum has been really hammered. So cryptocurrencies, meme stocks, unprofitable tech, Cathy Wood's famous ARK investments, you can see on the right-hand end of the scale there, have been beaten up badly. The flip side is you have seen pockets of resilience, defensive companies with reliable revenue streams like infrastructure on the left-hand side there. So how are we thinking about this and what are we doing with our portfolios? What is really interesting is that the things that actually matter to stock prices over the medium term, so things like long-term earnings growth, for example, those things have been pretty solid. So we take Xero, for example, here on the screen, and just last week it reported earnings and it actually beat revenue and earnings expectations. You can see the blue line there is actually being upgraded or lifted by analysts post the result. Regardless, the stock fell 40% into the result and then fell 12% on the day of the result itself. The reason I bring up this specific example is it's a microcosm for what we're seeing globally, that there is signs of irrational fear type selling in the market at the moment. And when fundamentals and share prices get unhinged like this, it's quite exciting for active investors like Fisher Funds. As long-term investors, we are constantly questioning whether anything has changed the width of the economic moat around the company's ability to elbow out competitors, the length of the growth runway, or the quality of the management teams of our portfolio companies. And the answer is that in 5 short months, unsurprisingly, nothing has changed. That is really reassuring to us as long-term quality growth investors. And as a result, we're seeing some much more attractive valuations in the portfolio than we have seen in years. So simplistically, if you imagine a company is growing its earnings by 20% per annum, and nothing has changed. Again, nothing has changed on that long-term picture, but the stock price is down 50%. Then the combination of the falling price and the ongoing earnings growth means that it has got significantly more attractive. So up to 60% cheaper on a price to earnings ratio on a 1-year basis. So we have been buying the most attractive stocks in our portfolio. You can see Xero on the screen there. We've been buying companies like Amazon, Microsoft, CSL, Fisher & Paykel Healthcare, and Cochlear. So what have we learned? After a tumultuous period like this, we always comb back through and figure out what we've learned. And we have invested as a team through the dot-com crash, through the global financial crisis, through the European financial crisis, through the US debt devaluation, and of course the recent COVID crisis or crash in 2020, and it never gets any easier. But volatility is inevitable. It happens every year, and every few years it is more severe. So for patient, long-term investors like ourselves, while painful, it is an opportunity. The other thing I've learned is it is critical we don't get knocked off our path by fear when these inevitable bouts of volatility arise. So to give you a quick example, if you had invested $1,000 in the US stock market in 1980 and held for 40 years to 2020, that $1,000 without you touching it would be worth $70,000. But if you did get nervous in the corrections and you sold out even for a little bit and say missed just 50 of the best stock market days in that 40-year period, that $70,000 would be worth $4,000. So you would have missed out on 95% of your return. So in summary, what happened? A lot of bad news is being thrown at the market, and that is very painful for investors. And the primary driver of that correction in stock prices has been the explosion higher in interest rates. So what do we think about that, and what are we doing with our portfolios? The long-term picture has not changed for our companies, and that is reassuring. So we're excited about the opportunities in front of us right now, more excited than we have been in some time, and we are buying. What did we learn? Again, volatility is very normal. We have seen it many times before in our careers, and we will see it again. But it's critical not to get knocked off our path by fear. I'll hand that back to you, Cath, and look forward to your questions in a minute.
Yeah, fantastic. So great to see some questions coming through. So just following on from that and what you talked about. So I'll start with you, Ash. In the terms of the Q&A. So Sam talked about the drivers of the recent market volatility, but I guess the key thing that a lot of our clients are asking about is how is this different to what we've seen previously? And is there a reason to think that this could be any better or worse than what we've had before?
Great, thanks, Cath. Cath, and good afternoon, everyone. It's great to have so many people on the line today. I guess with periods of volatility, there are always things that are similar and also things that are dissimilar from previous periods. There's always unique aspects. If it wasn't unique, then you probably wouldn't get the sort of the fearful reaction to things. I guess as KiwiSaver investors, we've got managed funding, KiwiSaver investors on the phone, but just even looking at KiwiSaver, since the start of the KiwiSaver scheme, we've had the global financial crisis, the sovereign debt crisis in Europe, we've had the COVID sell-off. So we've seen lots of different periods of volatility. I guess this one is quite different. It's been caused by something that we haven't seen for quite a while. We haven't seen a period of high inflation like we're witnessing right now since about the 1980s. So you have to go back quite a wee way in history to see a period of high inflation. And in fact, the last 10 or so years, we've had the opposite of inflation that was too low, and central banks were concerned about that. So again, it's unique, and it's the uniqueness is what causes investors to sit back and think and I guess worry about the future. But I guess if I was just to sort of draw comparisons to the global financial crisis or the COVID sell-off to the situation today, I would say one of the differences, I don't think the situation today is anywhere near as severe. The global financial crisis, if you can remember back then, we had a housing crash in the US, a subprime debt crisis, and effectively people were worried about the stability of the banking system, but not only that, the stability of some governments as well. So that was an extreme period in history. And likewise, the COVID shutdowns, I remember in the depths of that, we had businesses closing their doors. So they had no revenue coming in with all the expenses still there. So we hadn't had a period in history ever where you had a whole bunch of businesses, let's say a corner store with no revenue, but still having to pay rent. So we had this really odd situation. What we see now is a period of elevated inflation, which is sort of painful because it does hit you in the pocket, but we've seen this numerous times before, and central banks have a toolkit to deal with this. And in fact, if you look back to the end of the last big pandemic in 1918, or past other supply shocks like the end of World War I or World War II, we've actually seen similar events where there isn't enough production capacity or production capacity needs to shift from making one thing to making another thing. Demand picks up and you can't effectively meet that demand, and you have a short-term period of inflation. And that's what we're seeing at the moment, but ultimately that inflation could be self-correcting. A great example here would be oil prices. When oil prices go up, oil companies start producing more, and ultimately that becomes self-correcting. So I guess the big point here is this is unique. For me, it doesn't feel as severe as the last two big events that we've been through. But I guess one of the similarities that we've got to previous ones is the similarities are the headlines are always negative, sentiment turns negative, people feel quite bleak, asset prices fall, and actually that actually creates some really good opportunity for investors. You don't get opportunities like this in markets very often. It's every couple of years. So that is one thing that is similar.
Yeah, thanks, Ash. And actually that just leads on to a good question that we've got come through, and I'm going to ask you, Nick. So a very warm welcome to you in Christchurch. Hope it's nice and sunny there for you. So a question that we've got is based on what Ash said is now a good time to invest, or should I hold off or wait? So yeah.
Yeah, no, I mean, that's a great question. And as Sam and Ash have just illustrated, historically, if you're investing for the long term, there isn't really a bad time to invest as such. We are starting to see some good value in the market. So if you've got a lump sum you're looking to invest for the longer term, then now, could be a great opportunity to enter into the market. Given the current global situation, there are some strategies we could look to employ as a way of staging your investment into the market over a certain period of time. So you could consider breaking that lump sum up into smaller chunks and investing these regularly, maybe once a month over the next 6 months or so. So this type of strategy, which we often call dollar cost averaging, it can help smooth out some of the shorter term volatility that we might continue to see in the markets. So a really good example of this type of strategy in action is our KiwiSaver investors. Some of our KiwiSaver clients have been with us for over 20 years. They've seen cycles like this before that we're going through now. Others new to the investment and they haven't seen this type of volatility. But the great thing about KiwiSaver while you're still working is that you're always investing regardless of the market conditions. So your contributions go in each month and you're benefiting from that dollar cost averaging strategy, meaning you're buying units in your fund when the markets are low as well as when they're high. So over time, your average unit price is smoothed out, so to speak.
Yeah, thanks, Nick. And we've got quite a few questions coming here around the conservative funds. So I'm going to throw over to you to start with Ash. And the question is, I'm a bit surprised that conservative funds have fallen in value in recent months. Why is that? And could they fall even further, particularly if interest rates only go up?
Yeah, thanks, Cath. I've seen that question quite a bit in the feed here. So it is, and we get the question at the moment now because it isn't that common, and the conservative fund is less volatile than the growth fund. So you wouldn't expect to see that as often. Everyone knows that the share market fluctuates, so you get ups and downs with the growth fund. But in the conservative fund, I think if I looked at the Morningstar survey yesterday, and the average fund was down about 4% in the first quarter, and a lot of investors might be surprised by that. I guess the reality with the conservative fund is about 80% of a conservative fund invests in bonds, which are reasonably stable, and 20% is in the share market. So there still is a share market exposure. But the really interesting thing this time that we've seen is that the value of bonds have fallen as well globally. And I looked earlier at there's a global benchmark of bonds, and the Bloomberg Global Aggregate has fallen about 13% over the last year. It's an index of bonds, which is the furthest it's ever fallen since that index was created. And the reason for that is because interest rates have been rising. So if you think about a bond investment, it pays a fixed coupon every 6 months or so. And when interest rates go up, people are willing to pay less for that coupon stream effectively, because they can get that return potentially somewhere else like the bank. So we've seen bonds fall in value for the first time in quite a while, and that's why conservative funds have come down. The flip side of that, though, and the positive, is that as yields go up, that results in better expected future returns. And we have seen, for example, over the last 18 months or so, the New Zealand government bond rate go from about 1%, this is a 10-year government bond rate, from 1% to 3.5%. So the interest rate rises that Sam talked about earlier actually result in the expectation that conservative returns will be better going forward.
Okay, thanks, Ash. Another question here, Nick, for you. So someone has said, should I withdraw my money now? And I think we've touched on this before. Both Sam and Ash have talked a little bit about that, but I'm really keen from an advisor perspective. Should I withdraw now to stop any further losses and then invest again when the market has really recovered?
Yeah, look, at times like this during volatile markets, it can be really stressful watching the value of your investment heading down. As humans, we're hardwired to avoid pain or loss. So it is tempting to sell up to stem the bleeding, so to speak. But unfortunately, in doing so, you'll actually be crystallizing any losses you've seen. So right now, those losses are only on paper, but selling your assets makes those losses real. Looking at it another way, imagine someone coming along and offering you 30% under market value for your house. Are you going to sell it to them? It's pretty unlikely unless you need the money. It's a similar situation with your investments. We've always seen markets eventually recover from these types of downturns. So we do have to expect that this time won't be any different. The world's still spinning, people are still buying goods and services, companies are still making money. Just addressing that second part of the question, trying to time the market is also really difficult. As Sam and Ash have illustrated, picking the exact point at which the market bottoms is nearly impossible. And often by the time you sort of get back in, you've missed some of the upswing, which can have a really major impact on your overall returns in the years ahead.
Yeah. So what if you're really stressed, like you hear all this and you go, I'm so stressed, I can't sleep at night, I'm really, really, really worried. What would you talk to your clients about then?
Yeah, no, that's a great question. And again, it's totally understandable. It's never enjoyable watching your nest egg dwindle away. One of the main things to remember, though, is that you're not alone. We're all in this together. Hopefully, you're already in an appropriate investment strategy for your time horizon, your goals, and your attitude to risk. If not, it might be a great opportunity right now to have a chat with your advisor about your personal situation. We definitely have options available to you in terms of moving your funds around within our strategies to help manage market volatility. We often don't appreciate our true risk tolerances until we experience it firsthand, like we are now. Mm-hmm. So if you are really worried and you're losing sleep right now, get on the phone. Your advisor is going to be happy to discuss the options with you. Please don't hesitate to get in touch. We're here to help, and we don't want you quietly stressing in the background without having spoken to someone.
Yeah, that's great. Thanks, Nick. And I could see a question then around someone's, got 7 years before they turn 65 and starting to really think about that. So just reiterating what Nick said, ring us, get some advice and help, and then, we can really help you make the right decisions. Fantastic. So I've got some more questions coming through, and I'm going to put one to you, Sam, which is around the high level of rising interest rates and inflation. How are those things impacting the economy and the companies that you invest in right now?
Thanks, Cath. Actually, I was just thinking about Nick's comment, and I was remembering Warren Buffett's comment. He must have had just this correction in mind when he said, when you own a stock or a growth company, you've got to be prepared to be relaxed about seeing it fall 50%. So the master can do that. It sounds easy in practice, but that he must have had just this correction in mind. If we just focus on inflation for a start, it's absolutely impacting the companies we invest in. So it's driving up their cost of doing business. So the cost of raw materials is going up. Their wage bills are going up faster than they normally do. But what's really important here is, can those companies, or do those companies have the pricing power to pass on those cost increases to their customers? And in most cases in our portfolio, the answer to that is yes. And to give you one example, Fisher & Paykel Healthcare was loath to lift prices of its high-flow nasal oxygen product, which was the core treatment for COVID globally during the height of the pandemic, because it was more important to the company to supply the product to save lives. Now, as the pandemic has waned, they are absolutely lifting the prices of a lot of their products across the board at the fastest rate they have in a long time. And the reason they can do that is because, well, A, they've got a wide economic moat around their company, and B, because customers love their product. And if you do invest yourself personally, it's really important. That delineation is really important, because not all pricing power is created equal. Not all companies can lift prices to pass on these cost increases, Cath.
Thank you. So some really great questions coming along here. And I'm going to throw one to you, Ash, which there's a few questions around the impact globally, like Ukraine, etc., is having. So I wondered if you could comment on that, please.
Yeah, so it is interesting, the situation in Ukraine, and I guess the initial response to the situation in Ukraine and markets was quite odd, and that markets didn't fall, markets actually went up. But what we have seen is there are big question marks there around the supply of things like oil. So oil prices are now a bit higher than they were prior to the Ukraine conflict. That said, not that much higher. They've already been coming up pretty significantly ahead of that. But also things like wheat and fertilizer prices have come up. So it's another factor that's been feeding into this inflation dynamic that we'd already been seeing. I guess beyond that, though, assuming that the conflict doesn't move too much beyond the Ukraine and Russia, then we wouldn't expect it to have much of an impact on the broader global economy. Those two countries together are less than 2% of global GDP. That said, I would say, though, we have seen in some of the corporate results recently a little bit more caution in parts of Europe, a little bit of pullback in consumer spending in certain areas, just because of fear and risk that some people see, but nothing major to call out there. So look, I think the biggest driver of market won't be what happens in Ukraine necessarily. It's more likely to be whether or not central banks will get on top of this inflation, and whether inflation, the rates we're seeing now, prove to be peak rates, or whether they hold at these levels or go higher. So the real focus is probably not so much Ukraine, it's more inflation and interest rates.
Yeah. Now, I've got a few questions here for all of you, really. I'm going to start with you, Nick, around the definition of long term, which I think is really key when we're talking to investors. And then I'm going to go and talk to you, Sam, around what if volatility is implicitly short term and it turns out to be a sustained significant equities drop over the medium or long term, and would your strategy change? So I'm prepping you both ready. So there we go. Nick, I'll start with you. Tell us about long term.
Yeah, sure. It is a difficult one to answer, because everybody's sort of definition of long term is slightly different. But I mean, from an advice point of view, generally when we're working with 10 or more years, we'd sort of consider that long term.
Yep, great. Okay, Sam, on to you.
Yeah, excellent question. Look, first of all, let's remind ourselves of what our strategy is. So we are super long-term investors. We invest behind, or we handpick about 100 companies globally out of tens of thousands of companies. And the attributes we're looking for are companies that are run by high-quality management teams, real intelligent fanatics. Companies that have really wide economic moats around their businesses. So the simplest example of that is Auckland Airport. Last time I looked, they're not going to build another Auckland Airport. It's got a wide economic moat around its business. And importantly, they have really long runways for growth. So an example of that could be Xero, for example. Global cloud accounting penetration is less than 10% globally. We don't see any reason why that shouldn't become 100% over the years to come. So there's a really long runway for growth there. So those are the companies we're looking for. We really are trying to divorce our long-term view from any macroeconomic gyrations or market gyrations. In fact, those often provide opportunities. So if there was a further drop in equities, absolutely not, we would not change our strategy. In fact, that would just make us more excited about the opportunities in front of us.
Right. I've got a question here which said I might not get to, but I'll do it now, which is a reminder about getting in touch. So we have teams and advisors in Christchurch and Wellington, and of course Auckland, as well as our fantastic client services team. So you can email, live chat, pick up the phone, and of course, if you do want to come and visit us in the office, we'd love to see you as well. So a question here, I've got a question for you, Nick, and I've got two questions I'm going to put into one. One is someone is asking around, as a self-employed person, they've been putting the minimum in to KiwiSaver each year to get the government contribution, which is smart, so that $521 or so that the government contributes. If they've got spare funds, how are they best to invest, to top up KiwiSaver or set up a managed fund? And then just leading on from that, is it a good time to increase my KiwiSaver contributions? So some thoughts on that.
Yeah, there's a few things to talk about there. The first thing is great idea, contributing to get the government contribution. There's not many investments around where you can put $1,000 in and get 500 back out as a return straight away. In terms of the contribution level, if you've got a bit extra, Massey University did some calculations late last year and found that a retiring couple relying on New Zealand super would need to have around about 800,000 in KiwiSaver to fund a choices lifestyle in the big cities, or around 500,000 in the provinces. So the data indicates that most people are only contributing the minimum 3% to their KiwiSaver currently. So if you're 20 years old right now, you might be able to get to those amounts on this contribution level. But for those of us who are a bit older, that contribution level should probably be somewhere between 8 and 12%. Thinking of other options, managed funds are another alternative outside of KiwiSaver that does introduce a bit of flexibility, where you can actually access the funds if you needed to prior to age 65. So that that could possibly be another avenue for your surplus income as well. But if you're wanting to get an idea of where you're heading with your KiwiSaver or your investment portfolio as a whole, having a chat with your advisor now might be a good idea. So you can make any adjustments to contributions or other things as early as possible, to give yourself the maximum amount of time to get to the retirement that you're looking for.
Great, thank you. Now I'm going to go right one of the very first questions we've got, Ash, keeping up with these here, which is where are income from our dividends shown on our investments? And it hasn't quite finished, but how important are they?
Yeah, no, it's an interesting quick question, I guess, and I just try to understand what it means and whether it's shown on the statement, for example. But I think the way that we think about dividends, and Sam talked a bit about the way that we invest, we're looking for companies that that will grow their earnings over the long term, and if they grow their earnings over the long term, their share prices should follow. And there are two ways to get a return from a company. One is the share price going up or paying a dividend. Would prefer to invest in companies that actually have lots of opportunities to reinvest in their own business and grow. So we don't actually necessarily look for companies that pay high dividend yields. We'd rather invest in a great company that can keep all that money, reinvest it, and keep growing. And a great example would be Amazon. It doesn't pay dividends. It's never paid a dividend. It's always taken that money, the profit, and reinvested it in more data centers, more distribution centers, growing globally. And ultimately, that's what's really driven the share price performance there. So we're a little bit indifferent to dividends. What we really care about is finding great businesses that can grow, and that's really our focus.
Yeah, fantastic. Now, I've got a very good question here for you, Sam. I'm going to throw it at you around DGL Group. Actually, there's a couple of questions. So we've seen in the media recently about that remark that Simon Henry, the CEO, made about Nadia Lim. So there's a question about do we invest in them, and how do we invest? And I think perhaps you could tie it into another question, which is really thinking about our sustainability and environmental and what we take in consideration when we're looking at investments.
Yes, absolutely. So on the first one, no, we are not invested in DGL. Disgraceful comments by the CEO. And we were actually asked by another client, if we were, what would have we done? So if we were, which would be very disappointing, to be clear, we would pretty quickly try and understand whether those comments are indicative of a broader cultural problem at the company or just one person. If it was a broader cultural problem, it would appear we would have misjudged our view on the quality of the people. If it was just one person, we would probably engage and potentially try and force that person out. But remember, we handpick 100 stocks globally of the 41,000 that are listed, and people and culture is a huge part of that. Take Mainfreight, for example. One of the main reasons we invest in Mainfreight is because of their people, their excellent culture, and that drives superior customer service, and therefore they're taking market share at the fastest pace in their history. That's because of culture and people. So if we did miss that, we'd be very disappointed that we missed that. Mm-hmm. How we invest from a sustainability point of view, or ESG, we have an ESG committee. We focus on a couple of things there. Firstly, exclusion, which everyone does. So we won't invest in companies that do harm, munitions companies, for example, gambling companies, for example. But probably more importantly, and again, because we handpick 100 companies, engagement is really, really critical. And we're constantly talking to these management teams and boards about what they're doing and about their plans for the next 5, 10, 15 years, but also what we're seeing globally with best-in-class sustainability management, best-in-class environmental, social, and governance management. So engagement's absolutely critical there. If we didn't agree with something they were doing, there's several options available to us. There's more engagement, more pressure. That's one. Two is we could vote against any resolutions they've got upcoming in the AGM, and the third thing is we could just vote with our feet and sell our shares there. A very important part of our process. It's really been embedded in our process from the start, because if you think about it, we are long-term investors, and any company that is out there doing harm, acting irresponsibly, making disgraceful comments, for example, that are not helpful at all, it's unlikely those companies will survive and thrive over the long term.
Great, thanks, Sam. Ash, I'm going to ask a couple more questions, team. We've got quite a few coming along, so I'll just do maybe two more. One is, do you think we're at a Minsky moment, and do you think the Robinhood Hatch shares these investors could sell down en masse and create an even bigger crash?
I saw that question, and I think what they're referring to there is we've got a lot of investors, new investors to market that have invested in a certain type of thing. Will we see a panic which is sort of self-reinforcing, and one group of investors start selling, and then the price weakness causes others to start selling? And I'd say we've already actually seen that in parts of the market that the sort of the Robin Hoods and some of those shares these operators. Over the last few years, we've seen a lot of new investors jump into sort of these hyper growth, really exciting stories, whether it's electric vehicles, battery technology, genomics, all of that sort of stuff. These companies got really divorced from fundamentals and reality. Sam, in his slides at the start, showed the performance of that unprofitable tech index, and that's a lot of the companies that would sit in there, sort of new businesses, concept stocks that have lots of potential but no real business right now. And many of those companies in the last year or so have fallen 80-85%. So I think we've already seen a lot of that. Question if will that flow through to other parts of the market as well? Again, I think we've already seen some of that. So part of the reason for the market weakness this year has been the sell-off in some of the big tech names, for example, and that has been a bit of an extension of what we're seeing in those really hyper growth names. So actually, I think as a result of it, we've already had a lot of weakness, and we're actually seeing some really good opportunities. So, Amazon, I think, is down about 40% from its peaks, which in our opinion creates a really good opportunity here.
Yeah. And I'm just going to do one more question. And I know there's some that we haven't got to, but a reminder, please feel free to reach out to any of us and we'll be happily to answer those. So last question, Ash. There was a change around ratios around the balanced fund from a 50-50 mix to 40-60. Do you just want to touch on that for us?
Yeah, so we constantly, but generally every couple of years, we do a detailed review of our asset allocation across all of our funds. So within our balanced growth and conservative funds, to figure out what is the right mix between growth assets and perhaps income assets. And through time, we have added new asset classes too. For example, some people might not know that in our KiwiSaver funds, we actually have a direct property fund that invests in commercial property. For example, we've added other asset classes through time, like inflation-linked bonds. And we've occasionally set up some new investing strategies, like we have a value strategy, that the international strategy that goes into our KiwiSaver funds as well. So as we've added more of those options and more diversity, we believe we've been able to increase the the allocation to growth without increasing the overall risk by too much. So, for example, a great example here is the direct property fund, which is it's a growth asset. Its revenues tend to grow with or ahead of inflation. Those properties pay some great income yields, but it's not as volatile as listed property, for example. So we're constantly reviewing that and believed it was appropriate to take our growth weighting up. It was from 55, so from 55 to 60%.
Thank you. Right. Well, I think that's all we've got time for today. And as I mentioned before, if we didn't get to your question, please get in touch. I know one of the great things that I say every time is that we've got a great team of advisors, and also we work really closely with the investment team. So if there's something that you want to know more about, or one of our companies, we're happy to check with the investment team and talk to them around finding the right answer for you and to help reassure you. So a big thank you for joining us today. Please feel free to get in touch and enjoy the rest of your afternoon. Thank you.